One number is shaking up the global economic order: 1.2 trillion. That's the projected size of China's GPU market in 2025, skyrocketing from 34.5 billion in just 5 years, a compound annual growth rate of 32.74%. What's even crazier, global AI computing demand surged over 300% in 2023, with 2024 expected to hit 500%, while supply shortages reached 30%. When computing power becomes more precious than oil, an unprecedented chip war is rewriting the world's economic playbook. At the same time, a more shocking story was unfolding on the Shanghai Stock Exchange. Canberra Con, an AI chip company that had been bleeding money for 4 straight years, saw its stock hit 777.77 yuan, pushing its market cap past 300 billion yuan. Founder Chen Tianqi's net worth exploded from 32 billion to 77.5 billion yuan, making him Nanchung's richest man overnight. But that's just the beginning, for Chinese GPU unicorns are simultaneously rushing toward IPOs, planning to raise over 12 billion yuan with combined valuations exceeding 80 billion. In this trillion-dollar life-or-death showdown, who's going to come out on top? To understand the economic significance of this war, we need to first look at what Nvidia actually controls. In Q1 2025, Nvidia captured 98% of the global data center GPU market, shipping 3.76 million units and generating $36.2 billion in revenue. What does that number mean? Equivalent to Belgium's entire GDP. And that's just one quarter's performance. Even scarier is Nvidia's profit margins. Each H100 chip costs about $3,000 to $5,000 to manufacture, but sells for $25,000 to $30,000, delivering gross margins above 80%. This kind of pricing power is virtually unheard of in modern business history. It's even surpassing Apple's dominance in smartphones. Nvidia isn't just selling hardware, it's collecting an AI tax. But Nvidia's real moat isn't hardware performance. It's a $100 billion software empire called CUDA. 30 million developers worldwide are deeply locked into this ecosystem. With migration costs reaching tens of billions of dollars, it's like the entire AI world speaks Nvidia's dialect. And now someone wants to change this language monopoly? The sanctions have created an unprecedented investment opportunity. In 2024, China's accelerated server market hit $9.4 billion, exploding 104% year-over-year. GPU servers grabbed 92% of that pie, worth $8.7 billion. This growth rate is almost unheard of in global tech history. Capital markets went even crazier. More Threads is valued at 25.5 billion yuan, Inflame Technology at 16 billion, Burn Technology at 15.5 billion, and Meta X at 10 billion. These 4 GPU unicorns have a combined valuation exceeding 67 billion yuan. These companies aren't even 5 years old, but they're already worth more than many traditional manufacturing giants. The star market's 1+6. New policy opened a green lane for these companies, allowing unprofitable tech companies to go public. Enlisting AI chips as a priority support area, regulators sent a clear signal: develop domestic GPU capabilities at any cost. Investors put real money behind their confidence in technological independence. But this investment frenzy carries huge risks. More Threads lost 1.49 billion yuan in 2024. While Meta X burned through 1.4 billion, the cash burn rate is staggering. These companies need to achieve technological breakthroughs and commercialization before running out of money, or they'll become expensive martyrs. Sanctions didn't just bring stows, supply chain restructuring, they fundamentally changed the entire industry's cost structure. Data shows that GPUs purchased through third countries cost 30 to 50% more than direct purchases. With this sanctions premium directly driving up operating costs across the AI industry, for Chinese companies, these cost increases are across the board. It's not just hardware prices, but compliance costs, legal risks, and dramatically increased supply chain management complexity. A procurement head at a major internet company revealed they now maintain 3 to 4 different supply chains to handle various contingencies. increasing management costs by 200%. But sanctions also inadvertently drove business model innovation. GPU leasing, time-sharing, and cloud services rapidly emerged. Companies are accessing computing power through cost-sharing arrangements, shifting the entire industry from ownership to usage models. This forced innovation might create a more efficient business ecosystem than what existed before, skyrocketing. AI training costs are also changing technological development paths. Companies are being forced to focus on algorithmic efficiency rather than hardware scaling. This constraint-driven innovation is pushing the industry toward more sustainable directions. Ironically, sanctions might ultimately make China's AI industry more efficient and competitive. The sanctions are driving a comprehensive restructuring of China's GPU supply chain. Previously, Chinese companies were just downstream consumers in the global GPU supply chain. Now they're working to build complete upstream and downstream systems. From chip design and wafer manufacturing to packaging, testing, and software development. Every link is accelerating localization. Data shows that China's domestic GPU supply chain investments exceeded 50 billion yuan in 2023, involving over 30 core companies. SMI sees breakthroughs in advanced processes, Jiangsu, Changzheng, electronics technologies, advanced packaging layouts, and Empyrean Software's progress in EDA tools are all providing GPU industry support. This supply chain restructuring has enormous economic significance. Previously, Chinese companies could only capture 10 to 20% of an imported GPU value chain. Now they have the opportunity to control 70 to 80%. This isn't just market share transfers, an upgrade in value creation capabilities, but restructuring also faces huge challenges. Core IP licensing, key material supplies, and high-end equipment procurement all have technical barriers and supply risks. Building a complete autonomous GPU supply chain requires not just capital investment, but time and technical accumulation. This is a marathon that needs to be measured in decades. Cambricon's success is just the tip of the iceberg. The entire domestic GPU industry is undergoing unprecedented reshaping. Beyond the 4 IPO unicorns, a new batch of forces is rising. Kunlun Core, T-Head Desta, Iluvatar Corex, and Softgo. Each targets different market segments. This flowering of competition is extremely rare in global GPU history. For the past 20 years, this market has been basically monopolized by 3 giants: Nvidia, AMD, and Intel. But sanctions created a protected domestic market, giving new players unprecedented growth space. Like China's e-commerce and mobile payments in the past, the closed market environment actually fostered more diverse competition. Investment data confirms this trend. In 2024, Chinese GPU-related companies received over 20 billion yuan in venture capital. I'll triple the 2022 amount. Wow. Top-tier institutions like Sequoia, China, 5Y Capital, and Shenzhen Capital Group are all heavily betting on this track. These investments aren't just about financial. Turns their investments in national strategic security. But fierce competition also means resource dispersion and redundant construction. Dozens of companies simultaneously developing similar products could lead to industry-wide resource waste. How to differentiate in competition and avoid vicious price wars will be a key challenge for these companies. Behind the investment frenzy, valuation bubble risks are accumulating. Cambricon's PE ratio hits minus 400x, while MoreThreads is valued at 25.5 billion yuan, but has annual revenue under 500 million. These numbers have completely divorced from traditional valuation logic. The market's explanation is paying for future possibilities. But how big are these possibilities really, as compared to global peers? Nvidia's PE ratio is about 65x, AMD's around 35x. Even considering growth premiums, Chinese GPU companies' valuation levels are clearly excessive. This valuation structure reflects not just optimism about technological prospects, but deep concern about geopolitical risks. Institutional investor attitudes are also diverging. Some top VCs see this as a once-in-a-century investment opportunity, and are willing to accept high valuation risks. But veteran investors warned that current valuation levels have already discounted 5 to 10 years of future growth expectations. Any technological progress falling short could trigger valuation collapse. Historical experience shows that every technological revolution comes with valuation bubbles forming and bursting. The 2000 internet bubble and 2008 clean energy bubble are cautionary tales. The key question is this GPU boom a technology bubble or a transformative opportunity? The answer might not come until 2027 to 2028, under pressure from limited computing power. China's AI industry is carving out a completely different path. DeepSeek used relatively limited resources to create performance-challenging GPT-4, proving to the world the possibility of doing more with less. This isn't compromise, it's an entirely new technological philosophy. Efficiency over absolute performance. Tencent, Baidu, and ByteDance are all increasing algorithmic optimization investments. Trying to squeeze more performance from existing hardware? Data shows that through software optimization, the same domestic GPUs can achieve 30 to 50% performance improvements. This constraint-driven innovation is redefining AI. Competition rules. This efficiency revolution has profound economic significance. If Chinese companies can achieve the same AI effects with less computing power, they'll have huge advantages in cost competition. The cost structure of global AI services might fundamentally change, shifting from compute-intensive to algorithm-intensive. Western AI companies brute force aesthetics, infinitely scaling computing power and pursuing larger models might face challenges. When Chinese companies can achieve similar effects at 1/10 the cost, the entire industry's business logic will be rewritten. Sanctions inadvertently drove an efficiency revolution that might ultimately change the AI industry's game rules. This GPU war is full of paradoxical risks and opportunities. For China, the biggest opportunity is gaining technological autonomy, breaking free from foreign dependence, and potentially occupying the commanding heights of the global AI industry in the future. The 120 billion yuan market size is just the beginning. If technological breakthroughs go smoothly, China could establish a complete GPU industry ecosystem by 2030, with market size potentially reaching 500 billion yuan, but the risks are equally enormous. Wrong technological route choices, excessive capital speculation, talent drain. Escalating international sanctions, any factor could make hundreds of billions in investments worthless. Cambrocon's stock price crash has already sounded the alarm. For markets, when the tide goes out, you see who's swimming naked. For the global economy, the GPU war is reshaping the entire tech industry's competitive landscape. The traditional one-dominant player model is evolving toward two-power competition, which might bring more innovation and competition, but also increases systemic risks. If two technological ecosystems can't be compatible, the global tech world might face unprecedented fragmentation. The ultimate victory depends not just on technological strength, but on economic efficiency and market acceptance. History proves that the best technology isn't necessarily the most successful. What ultimately wins is often the solution with the best cost-performance ratio and most complete ecosystem. In this trillion-dollar gamble, everyone is a participant, and no one can stay on the sidelines. From the crazy stock price of 777.77 yuan to the 12 billion yuan IPO gamble. From the 120 billion yuan market pie to trillion-level industrial restructuring. Every number in this GPU war is redefining our understanding of the tech economy. This isn't just a US-China standoff, it's the ultimate showdown between two development philosophies: computing power scaling versus efficiency optimization, ecosystem monopoly versus technological independence, market dominance versus policy direction. Economic data has already provided preliminary answers. China's GPU market grew 250% in 5 years. Localization rates went from 0 to 20%, for unicorns are valued at 67 billion yuan. And entire supply chain investments exceed hundreds of billions. Behind these numbers is an economy's amazing resilience and innovation, its capability when facing technological blockades. But the real test is just beginning. Technological breakthroughs, market validation, cost control, international competition, each link is full of variables. Can Cambricon's stock price miracle continue? Will more Threads and others' IPOs repeat bubble disasters? Can domestic GPUs truly leap from usable to user-friendly? 2025 will be the decisive year. In this trillion-dollar life-or-death battle, victory will not only affect the technological strength comparison between two countries, but will reshape the future landscape of the global AI industry. Whatever the outcome, this war has already proven an unshakable truth. In the torrent of technological change, the fittest survive and innovators win. The US-China GPU war is writing the most magnificent business legend of the digital economy era.